Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil markets.
Paris Rapeseed. The pleasure I've recently experienced here in this daily chart is over. Or is it? Yes, prices have finally punched up and out of the early July to late October 2022 bearish Andrews pitchfork, which has the tines highlighted in purple. Below we have the broken upper tine, currently at 439 even. Currently also coincident with a congestion band, 438 even to a 445 3/4. And also with a flatlining short medium moving average, currently at 437 3/4. Quite a significant assortment of supports. But also add a question mark, for a little while at least, to the idea that this pitchfork is properly broken. Definitely breached, but maybe not quite broken. You see, last week the market punched higher, pushing up through the congestion band between 460.5 to 468 3/4, which contained the 2013 high at 464 1/4 and the June 2021 low at 468 3/4. Additionally, we had the shallowly declining medium moving average a little higher up, currently at 471 1/4. Coming in to reinforce that area. And these resistances, as well as the stuff down by the upper tine, eroded the bullish incentive enough that the market did not manage to get the requisite 2 clear closes over the medium moving average, managing just one, and a second close right on the moving average. Thus, the opportunity to move up within a, how did I put it last week? Within a wider and perhaps diaphanous congestion between 491 3/4 and 504 3.5, 504 1/2, which has the July 2021 low at 497 1/2 and a small gap from March between 497 1/4 and 497 3/4. Well, that turned out not to happen. And prices have dropped all the way back such that we're now sitting on top of the original congestion band, 438 to 445 3/4 right now. Does such action have elements of a breach rather than a break? Yes, it does. So what else does the action show elements of? Well, we could see a possible descending scallop pattern building here. But, and it is a big but, it will depend on what the market does should it get down as far as the May low at 386 3/4. And there's a lot in the way in the meantime. Before I sign off, I don't want you to forget the other larger pattern here. One that is so large that it has disappeared off my daily chart, but still sitting there, is a February 2021 to July 2022 ascending broadening wedge pattern. To be honest, it's a large but imperfect pattern, yet it had been the main market driver higher in the early part of 2022. The break lower in July last year left the following incredible targets on the downside, which I highlighted back at the time. Primary target X is in the 352 even area, which you can still see on my daily chart towards the bottom, and a harder to reach secondary target X1 in the 217 even area. These were at the time, well, pretty much way out there targets that you could put into your diary on a back page and just look at maybe once or twice a year. Winnipeg Canola. The drop over May, down through the 2021 low at 629 1/2 back 3 weeks ago, saw a recovery back up through the 2021 low and through the June 2021 low at 655.90 over the combination of declining short medium moving average, currently 699.60, and the newly drawn 2-pointer downtrend from early March, currently at 696.10. Then also the old July 2008 high at 710.80, which is the gateway to congestion seen throughout March, April and May, up to the July 2021 low at 761.90, and which has within it the declining medium moving average, currently 740.30. And it is within this congestion, just under the declining medium moving average, that the rally finally halted and pulled back down. The action over the middle of May to middle of June created a V bottom. Of that there is no doubt. But the question such a pattern raised was whether the V bottom would have an extension or a handle, and or whether it would even morph into a descending scallop pattern as well. So far, the idea of descending scallop pattern here is seemingly not a likely opportunity. However, the idea of a handle or extension on the V bottom, well, that has some credibility right now. Okay, so an extensional handle in this sense is that after a V bottom has formed, we have a period of sideways to possibly even slightly lower action before the market in theory resumes the move higher once more. That would seem a reasonable explanation of what we have been seeing this week here. The pattern that is formed is typically up to 15 to 20 sessions long and can be in the form of a bull flag, a pennant, or even a sideways triangle. Before I go any further, which to be honest I can't right now as there's too little data here, but before I drop down this rabbit hole, I would still like to raise again something I spoke about 23 weeks ago, and I quote, "There is just a thought, or maybe of what may be, the whole April to date action," so that's April 2021 to date, "it can be seen as part of a very large bearish halfway hesitation. It's all still too early on these thoughts, but I think they need to be present when things start to happen, eventually." End of quote. We were further along this course 3 weeks ago, and thus closer than ever to looking at this action as a possible, very large bearish halfway hesitation. I've even laid out potential targets below for such a pattern, with a possible downside target X in the 560 zone. Previously, I'd suggested putting this level in the back of your diary and looking at it every so often, just in case. The only issue was that it is now sitting at the bottom of my daily chart and is therefore a lot closer than some might imagine. However, I have a suspicion that while I still may keep it on this daily chart, its very existence depends on what, initially I thought, would be what the market does upon approach to the congestion overhead between 710.80 to 761.90, but which I now suspect can be finessed into what happens between the short medium moving average and the medium moving average. Now, I may finesse this further as the opportunity presents itself. First, Malaysia crude palm oil. In late 2022, the small but effective reverse head and shoulders pattern that presented itself at the time, amongst other factors, caused the market's move up into early November last year and eventually led to the construction of a new, mildly bearish pattern. It is the mid-August to early November 2022 mildly bearish shift pitchfork, which is highlighted in dark green on my daily chart. This mildly bearish pitchfork has guided prices more or less lower. Initially in between the upper time, currently at 41.88, and the middle time, currently 35.56, but more recently around the developing attractor of just the middle time. The island top back in early May led to the latest drop in prices, as we had a lower high in early May than in April and also in March. And if we take last and this week's actions, then this would be an even lower high. Prices in moving down from the island top overshot on the downside, dropping down through the June 2021 low at 33.26 and even the January 2021 low at 32.51. But not down as far as the interesting past price action back in November 2020 of a gap between 31.65 to 31.88. This gap was partially filled back in September last year, but it is still an open gap, if smaller. Well, the market turned up before then from this tweezer bottom and climbed up over the middle time of the bearish pitchfork and the declining short medium moving average, currently at 36.77, but slowed and stopped ahead of testing the overhead medium moving average, currently at 38.23, and the long moving average, currently 38.61. In the process, specifically over the last extended weekend, the market made a 2-day tweezer top, causing prices to turn around and fall lower. At the moment, prices have seemingly stabilized around the attractor again, the middle time of the bearish pitchfork, but this time reinforced by the 50% Fibonacci line at 35.17 of this very late May to mid-June move higher. So what now? Well, I suspect it very much depends on what happens at this combination of the declining middle time and the very, very recent 50% Fibonacci line. That may well decide what happens next. I will caution you about two things. Firstly, be aware of false breaks. This market has gotten the taste for larger moves in recent times, so be cautious and question any move in case it is a false break. Secondly, there is a time element here. You see, the middle time is slowly heading towards the 50% Fibonacci line, so it may seem reasonable to expect a move either before or after their crossover point. This point happens in the first week of August.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.